Trading Academy. I've been given a very good opportunity to finally put together a comprehensive, very thorough video training course, 4 levels that go through what I feel is the most relevant, pertinent, applicable strategies and the methods that are applicable in this market environment right now. And I want to talk about the environment because it's changed a lot. It's changed a lot even from a year ago, even from 2 years ago. And this environment, I dub it the thunder and tumbleweeds landscape. And that's because you have moments, you have those pockets of liquidity and momentum and magnified, robust moves every day in the mornings, and then that erodes. You get stagnation, the volume falls off, liquidity thins out, and the tumbleweeds start to roll across your screen. Okay, thunder and tumbleweeds. And I'm going to explain why we're in that type of landscape right now and how you survive and thrive in that type of landscape. So a little bit about me. Yuri did a good job pretty much telling you my bio. I've been around for over 15 years. Been trading the markets for over 15 years. I started off underground trader in 1998. Basically, it was a site that was kind of tired of the BS that you heard, the analyst upgrades, all the conventional mainstream stuff that really just, if you even had a level 2 screen, you knew they were full of it. Okay, when an analyst comes out and they make an upgrade and they talk about the stock and that, and how great it is, then you see their own market maker as an axe selling into those upgrades. So there was something really wrong about that, and the whole concept of underground means that you have to dig to get the depth, okay, of not just the markets, but anything, anything in life. And so through the years, I've put together, I've documented my journey in books and videos, and I've been, like Yuri said, I've been in Wall Street Journal, Financial Times, USA Today, CNBC, Bloomberg, and my latest book, Way of the Trade, is out by Bloomberg Press and John Wiley. So basically, I've been around, and through those years, I've catered to over 10,000 traders, fund managers, investors worldwide. And so I've had the privilege and also the heartbreak, okay, to witness and to guide, to train, and like I said, the heartbreak of seeing so many traders fall short. Okay, and it's not in the game plan in most cases. It's in the application, the execution of those game plans. Now, that's just a theme that has been present, all through the years. However, the market itself has changed. The market itself has mutated, okay, as opposed to evolved, because evolution implies something positive. Evolution implies growth, okay, that is organic, and it's enriching, and you're improving. The markets have not improved. The more things change, the more they stay the same. You hear that all the time. All right. Back then, you had Intraday, where the institutions access those terminals and those quotes, and everybody's talking about a level playing field. Everybody wants a level playing field, right? Everyone wants market transparency. Well, you got dark pools now, okay, and the dark pools do the same thing. They're trying to hide that transparency. That's the goal of the markets. The markets are trying to hide the transparency, and your job is to find that transparency before it becomes too transparent, before it becomes too widespread. Because once that transparency makes itself full-blown, the opportunity to make money, to profit from that, is gone. So let's go over real quick what happens with traders that I've seen. All right, whether you're just starting off, okay, or you're starting over again, traders, in the beginning, they tend to be very careful. Okay, they tend to be very careful, and they figure, all right, this time I'm going to do it right. This time I'm going to actually read the book. Okay, this time I'm actually going to sit back and just wait and let the trades come to me and plan my trade and trade my plan and all that other BS. All right, they start off here, but inevitably they try to take it too fast. And they end up here. You know, they figure, made a couple good trades on Apple. Let me just leverage it up. Let me load up on the weekly options. Next thing you know, they're up here, and they fall off. Okay, they blow up, and blow-ups are part of the game. You just don't want to keep doing it. And what traders, and not even just traders, but humanoids in general. Humanoids in general, you know, human nature is to simplify stuff. And so when it comes to trading the markets, people tend to see and focus, and traders tend to focus on this, the tip of the iceberg. And as you know, icebergs, 90% of the body is underground or under the water. But everyone is glamorized by this. They're glamorized by the profits that are made, the profits that are being pulled in, the money they could have made. Okay, how a stock move made sense. Everything that's on the surface. Oh, it's up. You know, stock's moving up. It's moving up. It's moving up. That's just the surface. Okay. The foundation is what lurks beneath, and this is a common theme, because in the markets, what are they trying to hide? They're trying to hide the transparency. Okay, and this is what looms beneath, what lurks beneath. The markets will give you a dime. It will give you a nickel, a quarter, 50 cents, knowing that it's going to suck you right back in. It's going to suck you right back in for a buck, for a 5, for a 10 spot. That's what the market does. See, the markets are a minus-sum game. It's not like Gordon Gekko and Wall Street where he says, hey, you see that picture? That's a zero-sum game. Some win, some lose. No, it's a minus-sum game. And a minus-sum game statistically means that the majority can statistically will lose. Okay, the majority cannot statistically win. It's a minus-sum game. So yes, the money is transferred from one side to the other, and it's constant. Okay, like the waves in an ocean. And in order to capture that money flow, you have to, number one, understand the game. Number two, you have to be able to interpret the action. And I'm not talking about, you know, Apple was down 25 points. That's not the language. That's not the language that's the language of up here, guys. Okay? The language down here is, you know, Apple formed a perfect storm breakdown, market structure high formed off of this level, blah, 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 blah. Okay? We're talking about traders' language, technical language. And this is what you're going to learn with the video course, because it's a whole different way of thinking. Okay, it's a way of thinking that focuses on this, so that this is a foregone conclusion. Okay, this is a foregone conclusion. This is going to happen. Everybody focuses on this, but it's the process. A plus B equals C. Everyone focuses on the C, but the A plus B, okay, that process is what generates the outcome. And I don't even call it an outcome. Okay, I call it a foregone conclusion. And you'll see what I mean. Now, going back to the good old days, not too long ago. Okay, in most books, you know, in most courses, whatever, they tell you that, hey, the markets have a totem pole system. You have the futures, they move first, then stocks are going to follow, then the options are going to follow, right? So you got your futures that move first, your stocks will follow, the options follow. So use the futures as a lead indicator. When the futures pop, jump in on the stocks, and then if you want, you know, ride the options, blah, blah, blah. Okay? Well, that was all great, and that works sometimes. But now what we're seeing a lot of, now once again, this is the general correlation. This is how things should be in the markets. But what we see now is we see a lot of this. Futures are up, stocks go down, options go sideways, up or down. Okay, and now I'm not talking about the futures going higher, strong, and then you see a sell fade coming in, and on heavy volume, which means that, hey, I should go ahead and look to short this stock when the futures pull back, okay, or peaking out. No, I'm talking about the futures are up strong, but the stocks sell down, futures come down, stocks pop back up. You see what I'm saying? And then once everyone realizes, all right, so there's an inverse correlation. Let's go the other way. What happens? It correlates again, just to shake everybody out. Okay, that is the byproduct of the thunder and tumbleweeds markets. That is the byproduct. That's what's going on right now. And the main reason for this is because, and I'm sure you guys have all heard about the algorithm programs and the high frequency trading programs, okay? These programs, these algorithms, and they're all algorithms, all right, you can't beat them. They're fast. They're too fast. They're co-located. They have more access. They have access to all the dark pools. They can throw up 20,000 bids and asks inside of a second. They can spam, spoof, and basically cross-lock markets so that you're sitting there scratching your head looking at delayed quotes. All right, they have that power. Now, they flaunted that power big time in 2011, 2010, almost to a point of just blatant arrogance. Okay, that's calmed down a lot. However, understand, so a lot of the older strategies that prior to the infestation of the algo programs, okay, and the high frequency trading programs, a lot of those older strategies, they don't work. You get burned. Okay, some of the best traders I know, who were literally like market makers, got decimated between 2010 and 2011, mid 2011. Okay, the rebate traders decimated. All right, pairs trading. Come on, opening orders. Okay, you can't fight the algos in their game. They're too fast. They have access. They have capital. They have co-location. So when they say don't bring a knife to a gunfight, that's exactly what these older strategies are doing. You're trying to play a market maker against the algo programs. That's crazy. And that's why you have to embrace a strategy that's calibrated, self-calibrates to the market, but hey, the bottom line is you got to play a directional strategy. And with my system here, okay, that's exactly what it does. Now, let me go right back real quick before I go too far off topic regarding the trading climates. Okay, a couple years ago, when you hear, hey, the Dow Jones is up 200 points today, okay. Well, you know what? It used to be a little more tradable. You kind of could use that as a benchmark, all right? But through the years, and as the volume has dwindled in the markets, the retail volume, that is, all right, we're noticing a very real trading climate conditions. And it's just like when you look out the window, you can't really see the wind, okay? Unless that wind is blowing the leaves on a tree, you can't really see that. But does that mean the wind doesn't exist? If you step outside, you can feel that wind. It's just like when it comes to the market trading climates, it's not based on the benchmark market general performance. Just because the Dow is up 150 points does not mean that the trading is robust, vibrant, and you're getting momentum follow through. Okay, oftentimes it doesn't mean that. In fact, there's a major disconnect. Okay, when the Dow is only up 12 points, it could be a wet climate where the gyrations and the oscillations are very robust, and you're getting really good oscillations and great follow through and liquidity. Okay, so one has nothing to do with the other. And until I coined this term, market trading climates, it's very hard for traders to explain that to humanoids. Well, the Dow's up, but it doesn't really affect the trading. Oh, well, you know what? You should probably get a real job. But the reality is that is reality. The market trading climates. And when you're able to spot the wet climates, and that's what I break them down to. It's just real simple. Two climates, dry and wet. And a wet climate is where you're going to get the momentum, the volatility, the robust price action. You're going to get follow through, okay, and strategies play out. The dry climates is where you get chopped up, head faked, and there's very little liquidity. And let me introduce you to what you're up against as a trader every single day. You have 4 types of opposition. You got the institutions, you call them big money, mutual funds, pension funds, hedge funds, large hedge funds, private equity, at least $100 million in discretionary capital. Okay, these guys are the dinosaurs. Back in the old days, a dinosaur couldn't walk in the sand without leaving footprints. Okay, but that was back in the old days. Now, you have the algorithm and HFT programs. These are like the Gatling guns, speed, rapid fire, capital. They can blow you right out of the water if you're dumb enough to go heads up against them because you're trading in a dry climate. Then you got your professionals. Now, I'm referring to the professionals that are working directly with order flow. Fund traders, market makers, okay, the prop firms, the prop arms of like banks and broker dealers and stuff like that. All right. Hey, if you have a 2 million share sell order on Microsoft from a Fidelity fund, all right, how can you not make money, right? And these guys have order flow. Now, back in the old days, you had axe market makers that you could see on level 2. Okay, and whether they actually had institutional order flow or a big order or not doesn't matter because they knew the game too. All right, it was the whole wink-wink system. And when Goldman Sachs sat on the bid, and all he had to do was absorb a little bit, and then everybody winks, and they jump in, and they know that Goldman Sachs is the axe. All right, you don't have axes on level 2 these days. However, I'm going to show you in the system, in the course, that there's something even stronger than that. The level 2 axe market maker of 2000, in 1999 to 2003, is now the boss charts, the boss rifle charts in this era. Then you have your retail traders, and that spans from all right. But most of them, unfortunately, look, they're humanoids. Okay, they can't compete. They're undercapitalized, undertrained. They're slow. They're stubborn. And guess what? They're a dying breed. They're a dying breed. So that's your opposition. Now, understand, like I said, you don't bring a knife to a gunfight if it is a one-on-one situation, but the markets are not a one-on-one situation. And when it comes to the wet and the dry climates, there's a very simple reason why you have a wet climate and a dry climate. You can take a very inexperienced trader, give him a few signals, okay, give him one setup, and say, when you see this setup, hit that buy button. All right, and in a wet climate, he's going to be able to make money. You take an experienced trader and you throw him in a very dry climate, and he's going to have a hard time making money. All right, he's going to have a hard time, and he may lose money. Okay, do you see the difference? So then you take an experienced or seasoned trader and put him in a wet climate. He's feasting. And like I said, the market loves to give you something knowing that it's going to get a big return right back many times over, many folds. So your pacing of being able to identify these climates and then being able to pace your activity, okay, to know when to ease off the brakes and hit the gas, ease off the brakes. That pacing is crucial. It's critical. And these are situations where it's going to have a material effect on your outcome as a trader. So utilizing the climates and the terrain, okay, that's part of the element that's going to make an immediate impact on your results. Now let's go through the 4 stages of evolution. Now I know that I've went over this in the introduction video, but I just want to go over it again because this, and let me tell you something, you're not going to find this stuff anywhere else, okay? This stuff is very unique, and if you do see it anywhere else, you know who came up with it, okay? And this is all exclusive to Alpha 7 Trading Academy. See, these guys have given me the lateral the lateral rights, I guess, permissions to be able to structure this course how I see fit. And like I said, this is a godsend for me, because I know that even, when you read my books, okay, and you see the perfect storm pattern, and it looks great, and you go out and you start looking for these perfect storm patterns, man, I shake my head, because the thing is, you're starting right at the top, man. You're starting right at the tip of the iceberg. And in order to be able to even earn the right, to be able to play a perfect storm, you're going to have to put in the real effort, the real workload. And that means starting from the bottom, building the building blocks, the mechanics, getting familiarized with the essence of price action, the essence of why stocks move, how they move, okay? In fact, you take all the labels off of all the chart patterns out there. Just think shapes, W's, M's, S, U, okay? Now, just with those alone, you've got head and shoulder patterns, you got cup and handle patterns, you got flag patterns, you got pup patterns, mini pup patterns. Do you see what I'm saying? Okay? They're all shapes, and they're very natural. They're very organic shapes. And so you got to start from there. You got to start from there, and then that's when you slowly start to add on the parts, the pieces, the building blocks of the mechanics and structure. And from there you take those pieces and you realize that there's synergies, and there's processes, and there's templates. And you have to observe the cause and reaction, because that's what the markets are. It's all cause and reaction. And you build that up comfortably, gradually. And you're not going to get that anywhere else. Like I said, this is how I designed the video course, okay? Because I've seen too many people fall off, with people with good intentions, but the problem is you can have all the energy in the world, but you're only human. And if that energy is not piped in the right direction, it's not piped, in the right template, you're going to wear yourself out. And when you do follow evolution, when you do follow the stages and you cultivate and nurture the stages of evolution, you know what you get? You increase your mental metabolism. And that is the affinity to get your brain working and to identify and understand faster, to absorb concepts faster. You're literally growing again. Remember what it was like to learn? All right? It's a wonderful thing. It's a beautiful thing. So anyway, before I ramble on and on for hours, acclimation. This is the first stage, okay? And we cover that with the level 1 of the training course. Now, as you start to get acclimated and you understand the essence, okay, of how stocks move, prices move, and markets move, then when you start to put the components together, and then you see each component and you see how they alternate, okay, and they work seamlessly, that's when you enter that conditioning stage. And with the conditioning stage, you've got proper templates, and you are repeating, recalibrating, adapting. And at this point, this is the point where you really speed up your evolution process. All right? You fortify your confidence, you improve your resiliency, your ability to adapt grows, you foster consistency, your anxiety goes down, your comfort level rises. Familiarity, okay, that's what combats anxiety, because you're used to it, you've done it, you've repeated it so many times. Conditioning. And that familiarity will stimulate your intuition. And that intuition leads to instinct, and you get to the seasoning stage. And this is where you're fluent in the methods. You're fluent in being able to see a picture of a chart, just to see the price action, or to see a tape, to be able to see level 2, just a few pieces, and you're able to spot. You're able to spot the smallest nuances, because you know it. You know it. You're seasoned to be able to spot those nuances quicker and faster than the next guy, and you're able to react on that. Razor sharp, precision reaction, foresight. and seamless integration between skill sets. And so at this point, what you realize is, I can do this much work, put in this much effort, and get this result. What if I can streamline that process, the A plus B, and still get the same C? Let's do it. Okay? And you're able to optimize. And during that, and as you optimize the process, like I said, your metabolism, your mental metabolism increases. It increases. It speeds up your affinity to gain new insights, new enlightenments. Okay, that speeds up. And the seasoning stage, and I mentioned this in the introduction video, the seasoning stage is where you get what I call the battle calm. Okay, the battle calm and the flow. And I could go on for another hour on that, so just check the intro video. All right, so as you get seasoned, then you're going to get to the specialization stage. Specialization, just like what a specialist does, okay? Laser beam precision, this is where you realize you make your money with size, okay? But you've earned yourself the size. You've worked your way up, and you're able to work pockets of liquidity. Because look, anyone can sell, 5,000 shares of a stock by hitting a button, all right? But if that stock is not very liquid, you just made a major market impact. It caused undue panic, and you probably screwed yourself on the fill. Okay, when you're specialized, you're able to liquidate that 5,000 shares like a ghost. Very little market impact. You take advantage of the liquidity without affecting the market. Okay, you're not sitting there with a 100 size reserve order, sitting there for 15 minutes, getting hit and not upticking. Okay, all right. Those reserve orders don't fool anybody these days. Okay, if you're sitting there like that, you can say goodbye, because they're going to pull the bids and they're going to just try to chop you right out. Like I said, going right back to the first few slides. That's what people tend to do. They tend to get a little confidence, and then they tend to just go balls to the wall and fall right off. So it is a gradual process, okay? Specialization process, this is the highest level, guys. This is the highest level, where everything is almost almost natural, okay? The nuances, the anomalies, and so what you've done is you have focused to get intimate with a book of stocks. A handful of stocks grows a little more, and now at this point you're able to trade baskets of stocks. Okay, you may trade a sector or a handful of stocks, or hell, just 2 or 3 stocks. Okay, but you're specialized. You know the behaviors of the stock inside out, all the anomalies. You've been there, you've done that, and the most important thing is you're able to size it up, and not make impact. It's the highest level of trader. Okay, market makers can't do that. Specialists, they can't do that. Okay, when all these market makers and specialists got laid off, they thought they were great traders. Guess what? When you have order flow, when you've got 1 million shares of an order for Fidelity to dump a stock, yeah, hey, you're a great trader, all right? You got 1 million shares backing you. Okay, but take that order flow away, and then let's see how you perform. And reality is they can't. So anyway, just to give you a glimpse of the tools, the rifle charts are a common tool that is created by me. Okay, and actually, I'm not going to say a common tool. It's a tool that is composed of very common, literally household products that's found on every single platform out there. Your moving averages, right? Your Bollinger Bands and your stochastics. 3 simple ingredients. Okay. However, napalm just requires styrofoam and gasoline. So It's how you utilize these charts. And the way I came up with developing these charts, it's a whole evolutionary process. What you see is the tip of that iceberg. But with the simple rifle chart on a 1 minute time frame, all right, we're able to derive these mini pups, mini inverse pup breakdown signals, mini pup breakout signals, pup breakout. Then we got our 3-candle sequence market structure high signals. All right, we utilize the trend lines to go ahead and connect the tops of the market structure high signals. And this market especially love people who try to follow a textbook and say, well, this is the market structure high. This is where we'll keep a stop. Let me step in and use whatever measurement, a measured target, this and that. Market loves to blast right through that stuff. Okay, when CNBC's talking about the 200 period moving average, all right, they love to take it that way, suck people in, and then just reverse that sucker. Okay, that's what they love to do. How do you think they drum up liquidity? What do you think algo programs do? All right, with less active participants, the best way to drum up volume is to go ahead and suck in the participants on a textbook breakout and then reverse it and panic them right out, flush them right out. Take that liquidity away from them, hijack it, kidnap it, and ransom it out at the highest cost. Okay, that happens daily. And so with my rifle charts, okay, and these patterns called perfect storms, pups, mini pups, okay, we are able to track those. And when it comes to these patterns, when you look at them in a textbook or, hey, even on your screen, right, they look great. Okay, they look great. Oh, man, that's great. And people who read my books, the perfect storm pattern makes so much sense. I'm going to go out and I'm going to look for them. The problem is, when you find them, the transparency is gone. It looks great in the book, but the reality is you got to be able to spot them at the point where they're dormant, right before the point that they detonate. It's not a hard concept to comprehend. But the reality is you're going to have to build up what lurks beneath. You're going to have to build up that base, that foundation, in order to be able to utilize that, to be able to find them, to spot them, to play them. Okay, it's just the way it is. Okay, it's the law of reciprocity. I have 5 laws of the marketplace. And law of reciprocity, it simply means that you are going to get out what you put into it. And if you're lucky, you put in enough effort that you end up getting a byproduct, which is the true reward. All right, now I'm going to just show you a basic, taking our core engine, all right, of the pup, mini pups. This is what I call a basic plan, a plan A fail-safe. This thing is about 80% probability. Okay, it's got the exact filters, and it's played on a 1 minute chart. Okay, the rifle charts themselves are adaptive, selective, self-calibrating. And once again, this is something that has to be applied by the right traders. Traders who have been through the whole foundation building process. So let's take a look. Okay, this is Tesla. All right. Okay, let's see. All right. For the presentation to play. Okay. All right. I think. All right. If not, I'll pop up the video. All right. Let's just. Okay. Let me do this, guys. Hold on. Time out. Let's see. This is not porn. Where is it? All right. See if you guys can see this. All right, here we go. All right, so this is Tesla, guys. Let's start over again. All right, right off the bat, this is the Plan A trade, okay? And this is a Plan A short trade. It's on a 1-minute chart. We have the rifle charts, the Bollinger Bands, the moving averages, and the stochastics. So in a Plan A trade, doesn't matter what stock it is, but you want a stock that's oscillating. You want to get a five period break, and then a bounce attempt that fades and curves the 5-period moving average back down. And when that happens and it slips through the 80 band, 1-minute 80 band slip, literally you can almost close your eyes and point to the next bumper, which is going to be that 20-period moving average. So in this example, okay, we have Tesla slip the 1-minute 80 band slip. Go ahead and we short Tesla 166.70. Okay, now Tesla's chopping 166.77, 166.90. Remember, this is the surface. Look, this is the surface that people watch. They're watching level 2, but they're noticing the level 1 quotes. This is what lurks beneath. The 1 minute taking a mini inverse pump. I know that if Tesla pops and tags at 1-minute 5, it's going to reject. The 1 minute, once it slips at 80 band, okay, once it slips at 80 band, this thing is going to gain more momentum to the downside. 1-minute mini inverse pump. I've played 1-minute mini inverse pumps. Well, hell, I'm the one who developed them. Okay, so thousands and thousands of times. So the next bumper right here, 166, 165.80. That's the 1-minute 20-period moving average. It overlaps the 5-minute 5-period moving average. Now look where Tesla's trading: 166.30, 166.50. All right, we're already putting in. We're already planning to go ahead and start to cover our shares in that 166, 18. Then we trim it down, take it down 166.16, 166.90, 165.90. So in other words, I'm planning ahead already because I know that this, whenever you get an 80 band slip with a 1-minute mini inverse pump and a 5-period slope down, this is almost a given that you're going to hit that 90, the next bumper, which is a 20 band move, which is a 1-minute 20 band. Tesla loves to do this, guys. It loves to chop around, okay, and spike real quick and then rug pull. So this is nothing new. Once again, once you get acclimated, okay, you'll be able to do this. But it's not something you're going to be able to jump in right off the bat and do. All right, the Plan A trade is, like I said, it's a fail-safe. It is a backup. Well, it's a primary plan for scalpers, and it's a backup anytime you're falling behind during the day. So now we got the open limit orders, all right, to start covering at 165.96, 165.18, and we're getting the leans here. And look, here's the 1-minute 20-period moving average, overshoots the 5, okay, and then that's it. We're just getting filled. All right. Now the thing is, when Tesla was up here, we're already planning for the move down here and having our limits set up. Okay. See, look at that. Drops down to 165.60s, 165.50s. Okay, which is also known as the Stinky Fives levels. Right. So this type of a setup, Tesla, that's almost that's $370. Okay, in less than 4 minutes. Now that is like I said, that is a Plan A setup, and it's a very simple setup if you're aware of, if you're aware of the strategy, and if you're also aware of how that strategy works, the essence of that strategy. All right, so this is what that Tesla trade looks like, guys. And let me tell you something. Just from the Plan A strategy alone, you're going to catch at least 4 to 8 of those a day, okay, on the long side and the short side on Tesla. And like I said, this is a very simple strategy, okay. It's not very hard. It's not very intensive as far as the methods are concerned. But it's a good introduction and a gateway strategy that allows you to add on and eventually get to what all roads lead to, is the perfect storm price patterns. And the perfect storm price patterns basically is when you get the law of convergence to kick in, and literally in high gear, and you get your mini pups on 3 or more lanes or time frames. Pup, mini pup, mini pup, mini pup, 60-minute mini pup. And when you get that, you get the clear parabolic straight movement. Okay, you get the clear breakdown, rug pull, shear, terror, lean down. Okay, that was just yesterday, by the way. RH, that was yesterday. Oh, that was beautiful. Morning short, afternoon short. Okay, perfect storm breakdown. You just get the nice grind down. Perfect storm breakdown, breakdown. See, look at that, look at that. Look how rich and beautiful that is. All right, it's just straight down. Perfect storm. Okay, these happen every day. Every day. You know how they say where there's a will, there's a way? Where there's a gap, there's a way of the trade. So, perfect storms, you're going to get to the point where, hopefully, you're going to be able to master these. Master spotting them, okay, tracking them, and playing them. And the perfect storms are going to be your highest probability patterns. And when you get a highest probability pattern, that's when you can size up. Okay? Because you always hear the cliche, oh, you got to know your risk to reward. Your risk to reward. And then you have people say, well, I want to get a 2-to-1 risk reward. Hey, that's great. Hey, have a nice day. Okay? Let's be honest. The reality is, you can't come to the market and dictate to the market, hey, for every 50 cents that I'm willing to risk, I want $2 back. Okay? The market's going to give you the bird. In fact, actually, it's going to give you $1.99 up front. You're not going to take the money. Then it's going to screw you. Okay, the market doesn't cater to anyone. My definition of risk versus reward, okay, means it doesn't. It's risk and probability. Okay, risk and probability. Reward is not part of the equation. The reward is this up here, and it's a minus-sum game. Most lose. Most focus on this. Okay, so obviously there's something wrong with that cliched, worn-out, broke-ass statement, risk and reward. No, it's risk and probability. What is risk? Risk is your exposure. What is your exposure? 2 types. Number of shares, your allocation that you take. Obviously, more shares, more risk. And the duration of holding time. The longer you hold your shares, more risk. What? Systemic risk at the very least. Systemic risk. And the risk of, news or whatever, or an algo program deciding, hey, they want to go ahead and rug pull it and hit all the stops. So the longer you're in a stock, your risk goes up. The more shares you hold, your risk goes up. When you leverage even more shares and hold it for a longer period of time, you're at the highest point of risk. So how do you offset that? Okay? Now, you can't sit there and tell me, well, I have my reward, and this is my system, and I'm, for every, 50 cents I risk, I want 2 points the upside. Okay, all right, well, have fun, but the way you offset that, realistically, is you have to offset it with probability. And probability is not what you want for a target, it's what the market's going to give you, but it's not even that. Okay, that's fantasy. Probability is based on bumpers, the next bumper, which are moving averages, price levels, Bollinger Bands, price levels that are going to find a reaction, literally support and resistance reaction levels, bumpers. And that's very clear, and it's right there. So in order to offset your risk, you need to offset it with higher probability. You see what I'm saying? And with higher probability, look, I like things cut and dry when it comes to that. Okay, we can sit here and debate, what's got more of a higher probability, bull flags, mark structure signals, 3-line breaks, cup and handles, W's, head and shoulders, whatever. Okay, now, perfect storms. Perfect storms have the highest probability. Now that as a pattern, okay, you're talking 90% and higher. What else? What about targets? Yes, the targets. Targets. Now, not targets that they're going to hit, but targets of what you're willing to accept. And so here's the equation, and it's really simple. The smaller your target is, right? The smaller your target is, the higher your probability, right? We all can agree a stock, it's easier for a stock to move 17 cents than it is to move, 40 cents or 50 cents, correct? Correct. Now, during different climates, okay, off the open, the first 30, 45 minutes, that's where magic can happen, and you get those type of moves. As the day wears on, the ranges, the levels get more rigid, and the dry climate sets in, right? Right. Okay, so understand that the other reality is this. Aside from that wet market open, throughout the day, stocks slow down. The dry climate comes in. Okay? So a stock, that will do 50 to 80 cent range in that first 40, 45 minutes, by 1, 2 o'clock in the afternoon, this thing is pretty much locked in a 20 cent range. Okay? Now, unless it is setting up for some type of a breakout or breakdown in the last hour after a long consolidation. But the reality is the ranges go down. Okay? So with that understanding in mind, okay, you're going to have to get the highest probability setups in order just to be able to keep up. So, like I said, it boils down to this. To be able to accept a smaller gain, price-wise, okay, is your highest probability. When you get the highest probability patterns, that allows you to go ahead and pick those levels of bumpers where you're able to take the money off the table into liquidity before it dries up. And as far as your risk is concerned, well, if you have high probability, the higher your probability, the more risk you can take. But even with the risk, you have to offset that, right? So the more shares you take, you want to make sure that your duration of holding period is proportionally shrunken down. So the most shares that you have in a position, okay, that 5,000 shares better only be 5,000 shares for a smaller period of time. Okay, maybe for a 3 to 6 candle sequence, on a 1 minute, whatever, all right? But as you scale out and scale down that exposure, then you're allowed to hold it a little longer. But everything has to be proportionate in that sense. And to me, scalping is all about managing your risk and probability, not risk or probability, risk and probability. Don't ask me about the reward, because the reward is a byproduct of that. Okay, I don't have to care. I don't even give a crap about the reward. The reward is going to make itself. The reward's going to happen. Okay, that's a foregone effing conclusion. And so that's why you have to think laterally, and you have to think down here before you can get to here. And this is what everybody promises you. It's bullshit. You got to start down here. And in order to do that, you have to make sure that you have the right templates, okay, and something that is going to help you follow that path and harness, harvest, and cultivate organically and progressively the evolution that you have the ability to achieve, okay? To become a seasoned trader, to be able to trade for a hedge fund. But you're going to have that foundation. I don't care how hungry you are, all right? Eat a Snickers bar. I can't tell you how many people tell me, oh man, I'm hungry, I got the desire, and they think that means sitting in front of the computer screen, looking at the tip of the iceberg, watching the inside bid and ask on Tesla, and watching that all day. That's not it. You got to put in the time, you got to put in the effort, the preparation to be able to scan, to be able to spot, okay, to do the real work, the preparation, the chart analysis. Doesn't take long. I can get you down to 2 minutes or less on any stock. all right, as you go through the courses. So as far as this 4-level video course, like I said, this is the most comprehensive. This is a juggernaut, okay? I put in as much work on putting this together than pretty much all 4 of my books combined, okay, and then some. Over 30 hours of video, over 700 slides, live action caption videos, meticulously designed, structured, in a lateral, progressive, depth, engaging approach that's going to organically cultivate your evolution to become a seasoned trader, to be able to trade for a hedge fund. And I'm going to leave it at that. Just remember this, guys, ladies and gentlemen, right? Know what lurks beneath. Think of the iceberg. Know what lurks beneath and plan for what lies ahead. And that is the essence of the trader training.
Thank you very much, Jay. I can take it over from here. Thank you for your participation, and thank everybody in the chat room for participating tonight. And if you have any questions, I would like to address them at this time in the chat room. So go ahead, anybody, and you can ask any questions about the program or anything you've seen here tonight, and I'll be glad to take those questions.